Welcome everyone this afternoon. We're getting a little bit of market movement, but let's remember we're still within the larger overall range in the marketplace. But today is a great example of a couple of things that I'm going to talk about today. Hopefully you'll walk away with this with a little bit different outlook on the markets, a little bit of optimism, and days like today can be taken advantage of, obviously. But it doesn't matter what the markets do, whether they go up or down, there's opportunity. And I want you to walk away with a greater understanding of that optimism about that opportunity. A couple other things we're going to talk about today. We're going to talk about using this trading style to fit your lifestyle, this approach to complement your trading. It's not the trading that's fun. I know a lot of people like the activity and so forth, and that requires a lot of skill, a lot of time, and a lot of discipline. My approach, my lifestyle trading approach here, using options, we'll talk about that in a second, as the vehicle, complements the active trader lifestyle. I was involved in that when I was younger. I guess it wasn't when I was younger, but years ago. You get, I would say a lot of times you're consumed by every uptick and downtick in the marketplace, and you can't go to lunch, you can't go to the bathroom, you're chained to your computer, so it requires a lot of discipline and a lot of commitment. So this can complement it. Like I said, it's not the trading that should be fun, it's the making money that should be fun. So today we're going to talk about how to use options, not stocks. We're going to show very, very simple option strategies, and the way that I attack the markets, I want to make sure that I'm only trading positions that have a 70% probability or greater. So right now is the best time in history. I know the market's been trading sideways largely for the last 3 months, but if you look at the big picture, a lot of the conditions have changed to make the retail trader now equal to and actually exceed the professional traders with many of the tools and techniques and abilities. With electronic access, you can trade any market, anytime, any direction, and there are multiple opportunities. When I was a younger trader down on the Treasury bond floor and down in the grain room, if you didn't take advantage of an opportunity, you had to be patient and wait for another one to come along. They didn't come along every hour, every day, every week, every month like they do now. If something's not happening in your individual market, back then you couldn't just step into soybeans, you couldn't just go over and trade gold, you couldn't just trade currencies. It didn't work that way. Now you can trade any market, anytime, any direction. And what's more important is the markets are very efficient. They have tight bid-ask spreads. You can get in when you want, get out when you want. There's plenty of buyers, plenty of sellers. What that means is the risk control is better than it's ever been. A lot of stocks trade in pennies. A lot of options trade in pennies. And there was just an article in the paper the other day talking about, I think decimalization was 15 years ago. Wow, it seems like it doesn't seem like it was that long ago. But remember, when stocks used to trade in quarters and in eighths, so you're giving up $12.50 for each 100 shares just to get in and get out. So think about that. Your commissions now are lower than that. So commission costs are a very small part of the equation. Remember at the time Bear Stearns used to charge $100. So it's a whole different ballgame. This is the best time. The opportunities are there. So the markets aren't good or bad. It's the opportunities are always there. Just use the right tools in the toolbox to take advantage of whatever happens. So if we just take a look at the markets, I'm still optimistic that the stock market is the choice for yield. If you look around the world, interest rates are extremely low. The yield on the S&P is about 3%. So it doesn't give investors much of a choice right now until rates move back up. But when they do move up, it's going to be gradual. There's about a 60% chance it's going to happen. Another quarter point will happen in December, and that gets us up essentially off of the mat, but still nowhere near that point where you have to make a decision whether you're going to look at putting your money in the safety of treasuries or you're going to be putting it in the stock market. They would have to raise rates a quarter every quarter for the next 4 years just to get back to normalized 4%. But look at the overall trend in the market. Only two things that I focus on. Price action. So if we look at the price action, you can't deny, there have been a lot of non-believers in this rally. The rally is what it is. Those people that have been trying to pick the top have been casualties. It's been very expensive financially and emotionally for those people that have been saying that the market can't go any higher. The market can do whatever it wants. There's no can't in the market. It can do whatever it wants. It's our job to extract money out of what the market's going to do. So you can see here over the last 5 years it's moved up, and each and every time it sells off, it snaps back and it actually goes the distance of that sell-off on top of those old highs. So if you look at the action here in the last year and a half, Actually, this should extend back a little bit further. We've been trading between 2120 and 2040 for most of this time. We had a couple of big drops, but came right back inside that channel. And now you can see with today's action, I just updated this right now, you can see with today's action, we come back down to that old resistance, that top from back in July. That old resistance is now support. So let's see how that holds on a weekly basis. But like I said, I only look at two things. I look at price action, and then I also look at volatility. All right, I look at volatility simply to tell me what type of tool that I'm taking out of my toolbox to attack the market. Is volatility high? Is volatility low in relative terms? And that'll help me determine which way I'm going to attack the markets. But if you look at the last 5 years, we get these periodic explosions when we get the market selling off. And this is the fear index. This is just simply volatility. And you get these big spikes in volatility. But each and every time, it's come back down inside that sideways trading range between 12 and 20. So the midpoint on that is 16. 16 is where we are right now, bouncing up once again. And you can see on the year chart, we've been trading between, again, that 12 and 20. But recently, over the last 3 or 4 months, as the market has consolidated, we've been trading between 10 and 12. Now, some people are going to say, well, it has to go back up. It doesn't have to do anything. If we go back down to 2007, the VIX was below 10. So to me, the fundamentals still remain in the fact that the stock market is the investment vehicle of choice, looking for yield. Earnings growth may have slowed, but earnings in dollar terms are still rather significant and a big, big deal. And actually, the earnings season is just starting unofficially today with Alcoa, but the banks are really what's going to set the tone when they come out later this week. So that's the opinion that the overall fundamentals remain intact. Maybe not the growth we would like, maybe not the pace we'd like, but it's been a nice 6 or 7 year run in the markets. The trends still remain resilient until proven otherwise. So, like I said, there's more downside in the VIX, meaning there's still more upside. The markets aren't complacent yet. Still possibly more upside in the stock market. So, about me, I've been doing this for more than 25 years. Started on the Chicago Board of Trade as a runner, like Renee had said. So I've seen all the markets. I've commodities, stock options, currencies, stock, futures. Again, it's not about what you trade, it's how you trade. I'm going to show you what I trade and why and what the advantages are as we go forward. But I've been doing this for a long time. Hopefully I don't look like an old grizzled trader, but I am. The first thing I tell people is to turn off the TV. Turn off the TV. Because there's not anything that they're going to say on CNBC that's going to help you make money. Understand that they're there to help. They're there to sell advertising. That is their goal. That is their function, is to sell advertising. So they want you emotional. They want you engaged. They want you watching each and every move in the market. So and a lot of times it's infotainment. Understand what that's all about. I go on the air periodically. I try and give specific examples of something I'm looking at. Yesterday I was talking about GDX. We've seen gold come back down to its breakout point. GDX is the gold miners and metals and miners. I'll show you that specific example and how to attack it, where to get in, and what option, what strike, what month, what to risk, what premium, and so forth and so forth. So hopefully I do things a little bit differently. What I want to talk about today is how to use this market fear factor in this elevated emotion. Everybody's very emotional about every up and down in the market. Are they going to raise rates? Are they not going to raise rates? You know, there's constantly information coming into the marketplace. It's a matter of how to factor that out and how it's reflected in the one thing. It's reflected in price. So you want to take that fear factor and use it to your advantage. If I stay till the end of the presentation, I will show you exactly how people have not done that, and in the past they've been 100% correct on direction, but they still ended up losing money. So I'll show you how to avoid that. So a couple of things I want to talk about today, and I alluded to lifestyle. I want to use the markets to fit my lifestyle. I want the markets to work for me, not work for the markets. I've got a young daughter. I want to be able to pick her up from school, drop her off at school, take her to dance, take her to softball. What else does she do? She does soccer. She's got plenty of things. So especially in the summertime, I want to be able to spend a lot of time. So I want to use the markets, and I want to use time in my favor. There are two factors that I want to control, time and probability, and attack the markets. And regardless, or irregardless, I guess is not a word, of what time frame you're looking at, trading is very straightforward. It's a very simple methodology. You want to evaluate what your cost is, your risk, your reward, your probability, and understand where your break-even is. And with those variables, you can effectively evaluate objectively each and every trade so you can make sure that it fits into your trading plan. Again, for me, I only now trade positions that have a 70% probability or greater. And I use the word trade and invest interchangeably. We don't invest like we did 20 years ago. You don't buy shares of stock and put it in a drawer and forget about it. You have to trade. Now a trader is a more sophisticated investor. A trader has a plan to make money. An investor just wants to make money. A trader has a plan. They know where they want to get in, they know where they want to get out. So that's the plan of attack. The way I do it are with options. Now, a lot of smart people and advanced traders are intimidated unfairly by options. Options are very straightforward, very simple. So there are a couple myths that I want to overcome about options. Number one, some people think options are complicated. There are 21 option strategies. Realistically, about 6 or 8 of them are for the retail trader. The others are multi-leg spreads and so forth that have too many legs to them and too many commissions and too many other variables. Try and make it simple. The markets can only do 3 things. They can only go up, down, or nowhere. You can profit using options based on where the market goes. Where it doesn't go, you can control time. You can control volatility. There are many different variables that you can anticipate to make money. So understand that options are very, very simple. The market can only go up, down, or nowhere. Some people think options are a gamble. The key here is to put odds in your favor. I'm going to show you exactly how to do that. Like I've said, I will only trade plays that have a 70% probability or greater. Trading a stock, you got a 50-50 chance the market's going to go up, the market's going to go down. All right? Why play that game? 70% is my sweet spot, and I'll show you how to do that as well. Time is your greatest asset, and patience is your greatest asset. I know it's hard to say in this business and in this environment with these markets, but if you can look big picture, I think you're going to be much more successful. And that's what I want to be able to do is be able to control time, have enough time to be right. If I'm an options buyer, if I'm an options seller, I want to take advantage of that time decay and do probability plays as well. Let me give you a quick example in XLF, and then I'll show you a live example of something we just did recently. The idea here is to do a stock substitution strategy, an option strategy using an option here instead of the underlying stock. So XLF is a financial ETF most people should be familiar with. The banks are in this. And what I wanted to illustrate here is how to profit from just a modest move over a long period of time in an underlying ETF. So we saw this ETF trade at about 22.5, let's say 23 back in October. This is an old slide, and then it rallied up to 25.5. What's interesting about the banking sector is this sector still hasn't recovered from the 2009 financial crisis, and it's at about the halfway point of the 2007 high to the 2009 low. So it's only recovered half. So it still has a lot more upside potential as these banks get their footing in the big picture. So how to play this from an option standpoint? What I did was I looked at what the low was for the year. I wanted to be bullish. The low was 1950. I wanted to buy an in-the-money call. An in-the-money call gives you the right to be long from, in this example, 19 for about 4.25. All right, the market was trading at 22.80. And so in that particular example, 22.80 minus 19 is $3.80. That option was trading for 4.25. So the break even on that was about 50 cents higher. All right, so a modest expectation, looking for that to move 50 cents. And in this example, because volatility is relatively low in historical terms, it's cheaper now than it was last year, cheaper than it was the year before, cheaper than it was the year before. So buying options is a better value. This option had 460 days. That was a year and 4 months of time, taking time out of the equation. Again, having enough time to be right, and over the 1 year and 4 months, expecting XLF to move up 50 cents. A very modest objective. The stock did move up, and you saw it did move up to 25, which from 23 to 25 is what, about a 10% move. But what was very impressive was the fact that this option gained 50%. So that's the power of options, that you saw the underlying have a modest move, about 8 to 10%, but the underlying moved up significantly. So if I look here at my Bullseye Options product here, let me just find it. I want to show a recent example, and again, another example of the stock substitution strategy, British Petroleum. All right, here's a trade alert. British Petroleum, we just took profits on this, and actually this is the second time taking profits in British Petroleum so far in 2016. And here we go. initially we had made money back here in July when it rallied up to 36. You can see the stock had been trading between 28 and 32, and a breakout above that 32 level, target at 36. We got out when it got to 36. It did go higher, so we left some money on the table. But again, the patience, over a period of time, it came back down, so we got back in, and we're leaning on this 32 level, buying a 28 call in this example, a 28 call, which is $4 in the money. I think the option cost $5 or so. So the break even was $1 higher, and then you saw British Petroleum bounce right back up and is now back up above 36. So we ended up making about 45% profit in 2 months. Stock substitution strategy. But what I wanted to show was that probability. Now here's that probability. I showed you in XLF that the delta on this is 83%. This is the only Greek that I'm going to use, is the delta here today. Well, I talk about time, but I don't get into the time component necessarily. So the delta on this was 83%, meaning there is an 83% chance that that's going to be in the money at expiration. Again, I'm choosing a deep in the money option as opposed to an out of money option. Unfortunately, novice traders oftentimes pick an out of the money option that is mathematically inferior in the fact that it's got low probability of success, and they often buy too little time. So let's buy as much time as possible, buy at a minimum of not 6 months, and all the positions I have now are for January, and the new positions I'm adding are March and June. So I'm taking time out of the equation for new positioning. But I wanted to show you that particular strategy to attack the market. So if you go back to here, you can see that there was an 84% chance of that option being in the money at expiration, as opposed to buying one of these cheaper options. There's a reason that option is cheaper. I would rather buy an option for $400 and put in a stop loss at half, so essentially I'm risking $200, than buy a cheap $200 option, because the $200 option has less probability of success. So that's the rundown on the stock substitution strategy. So that's one of the strategies that we employ right now at Bullseye. Also, some people think options are very risky. Like I said, you can put a stop loss on an option. If you're an option buyer, I typically recommend that you put in a stop loss at half, because either the market's gone the other way or you're running out of time. So also, you've got built-in risk control, because when you're an option buyer, no matter what happens, the worst that can happen is that option goes to zero. So that XLF option at 425 could go to zero. So that's $425. Worst case scenario, no matter what happens. So that's built-in risk control. And others think that options require too much time. The approach that I use in the example, that 1 year and 4 month option, shows you how it can fit into your lifestyle. You don't need to watch the markets hour by hour or even day by day. Maybe just weekly check in, see where we are in the big picture, because we're looking for development over a long period of time with rather modest expectations. In that example, the break-even was 50 cents away. In the British Petroleum example, the break-even was $1 away. So we're going to use these options factors in our favor and take advantage of what the markets have to offer. In this example, we're controlling probability, and we're buying as much time as possible. So we want this to fit your lifestyle, to complement, in addition to your active trades, if you have the ability, the skill, and the money to do that, be an active trader a couple days a week, or maybe more often than that. This is still something that you can do in the background, because these are probability plays that you can use to take advantage of the markets. There's another strategy that I think is underappreciated, and that's the one I want to concentrate on today. There are individual stocks that have high relative volatility, and that's like today, when that fear factor, when the volatility spikes up, when you're going to see that elevated level of emotion. That's what we want to take advantage of. There are guys here on the trading floor. I'm here in Chicago above the CBOE right now. The guys here on the trading floor that have the best cars and the best houses and the best lifestyles because they're option sellers. They sell those lottery tickets like we talked about that novice options traders buy. They sell those long shot, low probability plays, and they do that each and every month. Options series occur each and every month. So right now we've got the October options that are going to expire not Friday but the Friday after. Then there's November options and so forth, and December. So each month has a new option series. So what they do is they sell these shorter term options and let them expire, and they get to keep that premium. What I want to show today is a variation on that strategy to take advantage of individual stocks that have high relative volatility to, again, put odds of success on our side. What we're looking for here is to sell cash secured puts. And I can't stress the word cash secured enough. We have the money in our account, to buy the stocks we want at a lower level or get paid not to. So we're not doing this on margin. It has the same risk profile as a covered call. Everyone here, I'm sure, is aware of familiar with a covered call. You own an underlying stock, you sell a higher strike price call against it, and it lowers your overall cost basis if it expires, or if it gets taken out, then you make the difference between the entry price on your stock and the higher strike that you sold. So it's a win-win situation. Well, you don't do a covered call on a stock that you don't want to own, or you don't do a covered call on a $70 stock and take in $1.50 if the stock can go down to $20 or $30. This is a stock that you're committed to for the long term. So cash secured put has the same risk profile, and I'll get in that in a second. So let's talk about the strategy. The option wheel strategy, what we're doing is we're selling cash secured puts every month. We're selling those lottery tickets like the guys on the trading floor each and every month. It's all about the math. I can't stress enough. It's all about the math. It's all about probability. What I'm looking for is to get 5% or more in a 30-day period with a 70% probability. So this is a way to generate revenue each and every month in addition to the other directional trading, the other strategies. But the idea here is consistent small profits add up. So if you're getting 5% 30 days, some people are going to say, oh, that's not a whole lot of money. Well, go to a bank and see how much money you're getting on your bank account right now. Less than 1%. If you're lucky, you'll get 0.5%. So that's annually. So we're looking to generate 5% on a monthly basis with a 70% probability. So this adds up. Think of the rule of 72. The rule of 72 simply states you take your annualized return, 72 divided by your annualized return will tell you how long it takes for your account to double. So if you can get 8%, it's a healthy historical average, then 72 divided by 8 means that your account's going to double in 9 years. That's the power of compounding. Now, you can do better than that, obviously. If you're getting these small monthly returns with a high degree of probability, you can have a much greater annualized return than that. This option wheel is an investment manager trick to buy into stocks that you want to own at lower levels. So instead of putting in a limit order, you're looking at the markets, and a day like today, you've been waiting for a stock to go down so you could buy it. Well, what usually happens, unfortunately, is when the stock goes down, you very rarely step and buy it. All right, you're worried that it's going to go down further. That's just the nature. That's just human nature. A lot of times people should be selling. I'm sorry, when things look the best and buying when things look the worst, but it doesn't work out like that. People end up selling at the bottom and buying at the top. That's just human nature. That's psychology, and I'm not exactly sure why that happens, but it happens consistently over and over and over again. So this is a method to get into a stock that you want to own at a lower price. Think about an investment manager that's got an extra, $100 million or $10 million and it wants to invest in X stock. Well, it could put in a price down below and say, I want to buy X when it gets down to 75 and wait. Or they could use this investment manager trick, and I'm going to show you an example in Apple. Apple had been trading, excuse me, at 110 or so with a support level around 100. So looking at the chart, you're thinking to yourself, well, listen, I want to buy Apple when it gets down to, and I want to lean on 100 the next time it goes down. So I'd be comfortable buying it at 102, 103, something like that. So you could put in an order and wait, or what you could do is you could sell a cash secured put. So in this instance, there were how many days? 30 days left till expiration, counting on that time decay curve. So you're looking at this strategy that lasts 30 to 45 days before expiration. Again, because each day is going to tick off that the market doesn't move against you, and it's going to benefit you in that time decay. So in this example, you could sell the 105 put for 250. So 105 would be the price that you'd be obligated to buy the shares, the 100 shares. But you're taking it 250, so your cost basis is 102.5. So you're buying at 102.5, or you're getting paid not to. You're getting paid $250 not to. Now remember, you want to buy this stock. You want to buy it lower. Now Apple may not be the best example because it's a high dollar stock. What I want to do is look at individual stocks that I could own for weeks, months, maybe even years, high volatility stocks in relative terms that are typically lower priced. I'm looking at stocks that are around the $10 level. The idea is, a $70 or $110 stock has a lot further to go to zero than a $10 stock. So I'm typically looking at lower price stocks that I'd be comfortable owning for the longer term using this strategy. So here's an example in Sprint. I want to show you a more current example here. So let's go back to something that we just recently put on, It's a Freeport-McMoran cash secured put that we put on for the October. So let me go back down here for the October expiration. So even though the stock is moving down today, we'll show you a couple of things. Trade alert. Let me get you back on here. So that's for November. We got a cash secured put for Chesapeake. And you can see when the September options expired, both Chesapeake and Whiting, both those September options expired out of the money, so we get to keep that premium. So here's what we were looking at, is Freeport-McMoran. All right, and it's all about the math. Sell a October $9 put for 40 cents. All right, so in October, $9 put for 40 cents. So either we're getting paid 5% return in a month, or we're buying the stock 12% lower. So it's a win-win situation. So this is what it looked like when we put the trade on. And you could see that $9 level. We sold a $9 put, took in 40 cents, so our basis is $8.60 if we get it put to us. You can see that $9 level is a pretty significant midpoint support as the halfway point of this rally from 4 to 14. Well, just under 4 anyway. So 9 has been a very significant level. So instead of putting in a price order to buy at 9, you sell the $9 put. And if you don't get it put to you and get assigned the long shares, then you get paid 5% return in less than a month. So it's all about the math. So if we look at where Freeport-McMoran is right now, we sold that for 40 cents. Let me see what we have, FCX. Even though FCX is down 4% today, it's at 981. Let's remember, our break even is $9 minus the 40 cents we took in is at 860. So even though the stock has drifted lower, you know, we're still significantly above our break even. We're $1.20 above our break even. So $1.20, so that's more than 10%. So, and this option expires next, not this Friday, but Friday next. And if we had to buy it back right now, we could buy it back for 11 cents. All right, we're looking for that expired worthless. We'll keep our money. But what I want to show here is the probability. Looking at this delta, our break even is at 860. All right, looking at the 850 strike, it's got a delta of about 7%, meaning there's only a 7% chance that's going to be below 850 at expiration, meaning there's a 90-some% chance that it's not. So math is on our side. And I can let the markets do what they're going to do. I'm not concerned. I'm not losing sleep. I have the money in the account. I can buy the shares at an 860 price if the stock goes down in the next week and a half. If it's below $9, then I'll be long the shares from 860 the next week and a half. I understand the upside and the downside, and I'm comfortable getting long this stock at a lower level or getting paid not to. So that's the attack, that's the strategy. So here's a quick example in Sprint. We just went over it in Freeport-McMoran, and we, like I said, we put in positions on Chesapeake, on Whiting Petroleum. So taking advantage of high individual stocks that have high volatility and selling out of the money puts as a way to get into the stock at a lower level or get paid not to. So the best time for this particular strategy is when the option volatility gets inflated and spikes up. And here's an example, if you remember, was this Brexit 2 years ago? Not Brexit, I'm sorry, the Eurozone issue 2 years ago. We were able to sell some cash secured puts on a lot of things, but get a 5% return, a 12% return, a 6% return, a 4% return, a 7% return. Do a handful of these each and every month just based on probability in addition to our regular trading. And here last year, 2015, when we had the Chinese market correction, we were able to sell some cash secured puts, taking advantage of that increased volatility. Look at the math. It's a win-win situation. You're buying the stock significantly lower, 13% lower, getting paid 5% not to. 17% lower or getting paid 10% not to. 15% lower or getting paid 5% not to. So again, it's a win-win situation. There's no downside in this trade. Okay, excuse me. So as time goes on, we continue to take advantage of this each and every month. This is just one of the many trading styles here at Bullseye Option, but I wanted to show you some probability trades and show you the type of trades that can fit your lifestyle, can complement your current trading, that can simplify your attack on the markets and take the opinion out of your trading. Like I said, unfortunately, human nature is, you know, to buy when you should be selling and selling when you should be buying. But this is simply probability. It's something we can do on a consistent basis, rather methodically, on a consistent basis each and every month. So to get back to that U.S. Steel, sold the U.S. Steel October 13 put at 60 cents. So that put the break even at 12.40. So either buying the stock 15% lower or getting paid 5% not to. So that's a win-win situation. It's a win-win situation. Now what happened to U.S. Steel, and that's the beauty of this particular strategy, it profits if the stock goes up, it profits if the stock goes sideways, and it profits if the stock goes down, as long as it doesn't go down more than that percentage amount where your break even is. In this example, U.S. Steel went straight down. It went down 15% a month. Went down 15% a month, which is a huge move. So we were wrong. We were wrong, okay? But even though the stock went down 15%, it was still at our break even, and on that October expiration, it was at 12.48. So our break even was 12.40. So even though the stock went completely against us, we were still in the positive, and it was a win. It did get assigned to us, and that's the beauty of this option wheel strategy. If it does get assigned to you, what you do is once you're long the shares, you sell a cash secured put, get it assigned to you. Once you're long the shares, then you sell a covered call against it. In this example, because the stock had fallen 15% in a month's time, the volatility exploded, the options were much more valuable, much more expensive, so then you could sell a covered call against it. In this example, sell a $13 covered call for 80 cents. So you take in 80 cents, you knock that off your 12.40 cost basis, that puts your new cost basis at 11.60. So your profit potential between 11.60 and if you got called out at $13 is 12%. And if you don't get called out of the November option, then December option. Then you sell a December option covered call. Then you sell a January covered call. Continue to do that each and every month to whittle down your cost until you get called out. So again, it's a win-win situation. Only stocks you want to own that you could own for weeks, months, maybe even years, lower price stocks, high volatility, it's all about probability. But the key here is sell the puts, get the stock, sell the covered call. And it's only stocks you want to own at a discount. So think about it. You're buying a stock you want 10% lower, or you're getting paid 5% or more not to. It's high probability revenue streams. And the key here, it's something repeatable. Each and every month, there's individual stocks that fit our criteria. And if we go back to some of these trade alerts, I just showed you FCX. I was just looking at a new one in CLF, all right? Interesting that they're both, they're somewhat related. CLF is Cliffs Natural Resources. Selling the $5 put, and you could see that $5 level after the straight run up that we've seen in some of these miners and metal stocks, that $5 level is a significant pivot of midpoint support there. Selling the $5 put for 35 or 40 cents. So it's about the math. It's about the math in this particular instance. 7.5% return on risk, or buying the stock 16% lower. So again, it's a win-win situation. Now that October option has what, 30-some days left till expiration, but I'm comfortable buying. Each option I sell represents 100 shares. So for each option I sell in that example, I think that the break, what we say, the selling for 35 cents, the break even is 465. So then there's $465 in that account for each option that I sell. It's about the math. So that's a quick rundown on a couple of strategies that I think are extremely valuable based on the market conditions and based on what the markets are giving us. So let me answer some questions, but let me first tell you about Bullseye Option. I showed you a couple of the comprehensive trade alerts. It tells you what sector, what stock, what option, what strike, what month, what premium, and what risk. So very spelled out trade recommendations. Look for one or two of those a week. But again, they're longer term. They're not something that you have to monitor or manage. You're looking at things with a more hands-off approach so that you can live your life, so that the markets work for you. not you working for the markets. In addition, you're going to get a morning market commentary email sent to you with information on what happened the day previous, some levels that I'm looking at, and maybe some unusual option activity or something that's got my attention to pay attention to. In addition, you're going to get the daily videos. Let me just look here and see where this is at. Each morning I go over to the exchange here, and here's an example of the morning email. We're talking about Apple earnings yesterday, what happened, unusual option activity in CF Industries and Bristol Myers. So you get that delivered to yourself each morning. If you want that kind of information to build your knowledge base, that's great. If you want to just trust the math and the probability, that's great as well. But each and every morning I go over to the exchange and I do a morning market commentary before the markets open about what the futures, stock futures are doing, interest rates, oil, gold, to set up the day. You're also going to get daily videos. Yesterday I was on CNBC, so I post that as well. I was on Bloomberg, so if I'm on the air, I'm going to post that as well. Oh, hang on, let me turn that off. That's or you've got the CBOE TV. So there's solid content about what I'm paying attention to and what I think is important to focus on in the markets every day. You also have a bi-weekly AskAlan online power session. The next one is not scheduled for Thursday, it's the Thursday after, so it's going to be the day before expiration, so we can update on the positions where we stand, the winners, where we are with those. So you get a comprehensive package at Bullseye Option, the Inner Circle membership. Try it out at bullseyeoption.com/TRY, bullseyeoption.com/TRY. So let me put that in the, where we got here, in the chat box and in the question box, and then I'll answer some questions as well. One question that I'm getting here is, as far as allocation goes, okay, that's dependent upon your account size. So what I try and encourage people to do is, some people think that they want to be a 2-lot trader, or a 5-lot trader, or a 10-lot trader. It's not the number of contracts you trade that's important. It's the dollars that you're allocating to that individual position. You want to divide your account equally, and you want to weight each trade equally. So no one trade has any more importance than any other. So for simple terms, take your account, divide it into 20 slices of pie. So each and every trade would be 5%. All right, so if that trade goes bad, you've got 95% of your account left. And if you follow the 50% exit rule for options, you know, buy options, put a stop loss at half of what you pay. If you're wrong and you get stopped out, which is not a bad thing, as I've gotten older, I enjoy it more. I'm not saying I enjoy being stopped out, but I appreciate being stopped out a lot more. You can always get back in. All right, that's something that we don't appreciate at the time, but you can always get back in. It's a lot better to be thinking of a way to get back in than trying to scramble and figure out a way to get out. Because not only does it hurt you financially not getting stopped out, an option can turn around. It can always go from very low value and anything can happen in the market and come back. But mathematically, more times than not, it doesn't. So you're better off to recover what you can, get in a salvage operation, get out at the halfway level. And if you do that, instead of risking that 5% on each trade, you're realistically risking half, which is 2.5%. So you have 97.5% not affected by any one trade. So divide your account into 20 slices of pie. Someone asked questions about, do credit debit spreads work on higher price stocks? Yes, Ron. That's what you sometimes have to do because, well, now that the volatility is lower, it's still more efficient if you can to buy an outright call or put. But in something like an Amazon or something that's a couple $100 stock, right? You have to buy a call spread or a put spread. And right now, because volatility is relatively low, it's more efficient to go straight outright buy the option. But some of those stocks make it prohibitive. But when given the choice, I'd rather just buy an option because you've got a lot more flexibility. A spread's only going to be worth its maximum value at expiration. So you lose flexibility, whereas you could see in that British Petroleum play, there was plenty of time. It was a December option, I think. I'm sorry, a January option. And we exited last week, so there's still 3 months of time in that option. We just had that luxury. If we need it, great. Buy more time than you need. Because if you can use it, great. If you can't, who cares? But the problem is, if you're going to put on long-term spreads, it's not going to be at its maximum value until expiration, and that's the downside for that. So someone asked what the fee is for the 1 month trial. $7 for the 1 month trial. 30 days, you're going to get the trade alerts, you're going to get the videos, you're going to get the morning update, you're going to get the bi-weekly power session. So you're going to get a lot of content and information. But the key here is it's all about probability. And it's all about a simplistic approach to the markets to make it easy. Use the math. Understand how to put things on your side. I'm not here to outsmart the guys at Goldman Sachs or Morgan Stanley and you know, be an active trader. I'm going to use options to take advantage of longer term trends and probability, putting the odds on my side, putting risk reward on my side. Someone else was asking some questions here about brokers. The brokerage firms I like to use, Thinkorswim or Trade Monster, which is now Options House, are brokerage platforms built by options traders for options traders. Now, this is not an active program, so you're going to be doing a couple of trades a week. So, you know, whatever platform you're comfortable with. Now, all electronic platforms are, you know, have the same bells and whistles. It's just whatever you're comfortable with, whatever makes it easier. And again, commission should be very, very nominal here. You know, $5 or $10 a trade. So, you know, that shouldn't be a factor. But there are some brokerages that there are a couple times we do a strategy, Iron Condor strategy, where you're taking advantage where the market doesn't go, selling a credit spread above but a credit spread below, and counting on that time decay, look for the stock to stay within a range at expiration. But it's funny that some brokerages don't get it, and they'll take margin on both sides, but the market can only go against you one way or another. So, you know, understand that some brokerages aren't as financially coherent and versed in options as you may want. Someone asked about the delta. It comes back to the delta. The delta for me helps me understand the probability of the trade. So I'm looking for, if I'm an option buyer, I'm looking for a delta of 70% or greater. Okay, if I'm an option seller, I want to sell options, and I want to have a probability of 70% or greater, so I want to sell options that have a delta of 30% or lower. Because if there's a 30% chance that it could be below that, that means that there's a 70% chance that it's not going to be. So it's all about the math. It's about the math. I have good instincts. I've been around the markets a long time, but I don't want it to be about what I'm thinking. I want it to be about probability and about the math. And that's where this methodology comes back into play. That, you know, you want to understand what your cost, your risk, your reward, your probability, and your break even. And if you can look at each and every one of those, you can make an informed, unemotional decision about what's happening. So let me just take a quick glance since we have an extra minute here. What time did we start? We started at 1:30, so I guess we're just finishing up. I want everybody to sign up at bullseyeoption.com/TRY. Let me just reply to everybody, put it in the box here. So think about how much easier it can make your life to trade with this sort of approach, and from a time standpoint, to attack the markets with these probability plays. Bullseyeoption.com/TRY. Let me put this in the chat as well. I want to appreciate everybody's time today. And I didn't take a peek at the markets, but when you walk away and you see days like today, think to yourself, you know what? Those are days that I can use this cash secured put strategy to take advantage of other people's fears. You're taking advantage of other people's fears. There are people that are losing their minds today because the market's going down. You know, the market's going down, how to handle it, and there'll be people that'll be panicking, there'll be people that'll be selling, you know, and sometimes they end up selling at the bottom. That's just unfortunately the way it works. But you want to be able to use the right strategies to put the odds on your side, and that's what I try and do here. The one thing I wanted to show that I said I would at the end of the presentation was how people, even though they had the right direction pick, still ended up losing money. So let me just type this into the chat room, just 1 second. bullseyeoption.com/TRY. Oh, I think that just went to one person. Sorry. Did it? Okay. Okay. There it went to everybody. All right. So what I wanted to show you is let's go into the SPX and go back to February, for example. You know, people might have been right about picking, you know, identifying the bottom in the market and buying calls when the market was way, 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 way down. But people still ended up losing money because the volatility had spiked. So when the volatility had spiked, the options became that much more expensive. So if you look back here in February, so even though they bought options, what happened was people that bought calls at that point, they bought options when the volatility was inflated. The balloon was fully filled up with volatility. So the options were expensive, and buying out of the money options, they still ended up losing money because they bought too little time. So what you want to do is, and I showed you with that stock substitution example, buy in the money options, because the component that's impacted by volatility is the time value. So the time value is the difference between the real value of the option and I'm sorry, the option premium and the difference between the strike. So the break-even on that one example was 50 cents, and I think the break-even on the other one was $1. So the break-even distance is what's impacted by volatility. So the small part of that is impacted by volatility. So when it's expanded, it's not that much more expensive. But if you're buying out of the money options, it's all time value. And if it's all time value, if you buy it when it's inflated like this and it just melts in your hands and all the air comes out of the balloon, even though people were completely right, they still ended up having losing positions, not using the right options at the right time. So that's the lesson we learned. But I want everybody to sign up, bullseyeoption.com. My name's Alan Knuckman, Alan Knuckman at bullseyeoption.com. If you have any questions, these are a couple of strategies that I employ, but the message to be communicated today, it's about having optimism, being able to turn lemons into lemonade, turn that frown upside down, make it easy, use options as a vehicle instead of stocks, make it, the market simple to understand and put probability on your side. That's what it's all about, is controlling the odds and putting probability on your side. I choose positions that have a 70% probability or greater. That's my sweet spot. That's what works for me. That's what I found to be successful. And looking at success this year, we've had an amazing year at Bullseye. Bullseye, I just updated this year, 32% profit, 32 profits out of 36 closed out trades. 32 winners out of 36 closed out trades. So that's an amazing success rate. And here's some examples of the power of options, that small moves in the underlying option can generate big returns. So JP Morgan Chase 60%, UNG 86%, GLD 50%, GDX, and I'm looking at a new GDX position right now, 110%. So you can see these exponential returns in modest amounts of times, 5 weeks, 6 weeks, 2 months. Now these options still have a lot more time, but when you can get a 50% or 100% return in a short period of time, it behooves you to take it. Put it in the bank. You can always get back in. And the British pound was the British petroleum was a great example. We ended up making money on that twice instead of riding through it and then riding it back down and riding back up. We ended up getting out on that first rally, getting back in when it went down, and then taking profits here recently. So here you go, 45% in 2 months. Here's one that we were wrong on. Alibaba, we were 100% wrong. Well, wrong in a good way. Alibaba traded between 72 and 82, so the target on that was 92 on the breakout. We ended up making 50% in a month. It did go all the way up to 105, so we left a lot of money on the table. But you know what? I can live with that. A 50% return, put it in the bank, you can look for new opportunities. You can never complain, and I have had some customers unfortunately complain about a 50% return. And one of them, which I found really, I guess, ironic, amusing in a weird way, was this GLD play. GLD, we ended up making 50% in a week. A week on that investment. That's a heck of a trade. We left a lot of money on the table because gold continued to go up, but guess what? It's come back down. We're looking at new opportunities in gold right now as we speak, because markets often come back down their breakout point. And speaking of gold, here's a testimonial from a customer that ended up making some money. Now this is a function of his account size. He's obviously got a very large account. That's not what I wanted to talk about. I wanted to talk about the underlying GDX, which are the gold miners, moved about 7 or 8%. Okay, 7% move. That's a good move. Can't complain about that. That's a good move if you can capture that. But the right option returned 53%. Again, the power of options. I'm not here to dazzle anybody with my sophistication or my math. I'm trying to communicate that this is very simple, and it's a strategy to put probability on your side and put the odds in your favor. So that's what this is all about today. I want everybody to sign up at bullseyeoption.com/TRY